This is the Ozone Radio Show, where we bring you facts, not fiction, by focusing on timely information you can share with confidence. Because we value realism, not sensationalism or shock value. So join us now for ideas and information you can use right away.
Welcome to the weekly Ozone Radio Show. I'm Robin Trimmingham, and my guests today are Olderhood Chairman Bill Storie and Ian Price, a UK financial expert. Today we're talking about protecting your retirement fund to last a lifetime. Okay, guys, I think that this is a great topic. I think our problem here is going to be wrapping this up in a timely manner, but start us off here. What are the key things that we need to think about, Ian, to protect both capital and income so that it does last a lifetime?
Robin, it's great to see you both again. I was thinking about this a lot, and it's really interesting. Since we've been doing these podcasts or whatever, we've really hit what the issues are with retirement. Even this year, we've seen inflation come back onto the agenda. We've seen higher interest rates coming back onto the agenda. And as I sit here today in the UK, market volatility's come onto the agenda massively. So even the last 3 or 4 months, we've seen a snapshot of what the issues are for most people in retirement. Does that make sense? About how do you protect that income against what is happening in the world? And I think from my perspective, it's understanding this, not panicking sometimes, if I'm really honest. And we've said this before, when you build your investment strategy or portfolio for income in retirement, for want of a better word, you've got to build in safety nets. And I think the last few months has really shown us why having sort of a guaranteed income, as well as flexible income, is so important. And I'm sure Bill and I have the same sort of era. We're much older than you, Robin. We've seen inflation in double digits before. So I think people are a bit shocked by this. But it's really important to understand the little bit we've seen in the last couple of weeks or months is really going to have a big impact. I'm sure Bill would agree.
Yeah, I think what happens is that people focus almost entirely on how much money will I need in retirement, namely the retirement fund, which is fine. I mean, clearly there's nothing wrong with that. But if that retirement fund is somehow going to dribble out as you get older, and especially if you want an inheritance to be left behind, in other words, your estate, then you've got to take that into consideration. And I think what happens is that people look at the retirement fund from what we would call a capital perspective. What is the value of the fund? And I think sometimes they kind of ignore or just overlook the whole question of income. In other words, I mean, if you don't have the income, then the only way you're going to live and pay your daily expenses is to tap into the capital side of your retirement fund, which correspondingly reduces the subsequent income. So I think it's a very interesting point that we're making here, that you don't just concentrate on how much money you're going to have on the day you retire, but what is your cash flow going to be like? What is your income going to be like as you get older?
We started to see, the classic model is always make sure you've got enough income for a couple of years in case something happens. Because obviously, if at the minute markets are going down and you're having to sell assets to provide income, you're having to sell more assets to provide the fixed income you want. Does that make sense? So in other words, you've got to be really careful that the market, like you said, can erode your capital very quickly if you're taking income out of that capital and the market's going down. So having the balance right, what we always talk about, I think is now more relevant than before.
I was going to ask a question, and you know me, it's going to be from the layman's point of view. One of the strategies that I've heard about, if you are concerned about what the impact of inflation and things will be going forward, is to have different pots of money and to not have them all trigger at the same time. So for example, having a mutual fund or a term deposit that you don't dip into at all until you're, say, 75 or whatever age seems right to you. And then at that point, you start taking income or capital from that pot of money. What do you guys think of that?
Well, I think one of the things, I'll give you an example. My daughter, who is over 40, probably shouldn't say that, but nonetheless, there we are, sent me a WhatsApp. We actually live close by each other, but nonetheless, we communicate through WhatsApp. Strange, but there we are. And she said, my God, she said, I've just had a look at my pension statement. I mean, she works, she's in the insurance business. And it's gone down, the value has gone down by X number of dollars. And it was a reasonably significant number, to be fair. And she said, my God, what do I do? So, I mean, I went back and I said, well, you do nothing. Nothing. I said, your value has gone down, all things being equal, notwithstanding markets and, world disputes and inflation, obviously, sort of thing. It will come back up because you've got to remember something. You are not taking pension income at the moment, unlike some of us. Mm-hmm. I said, so you don't have to worry about this. And she said, oh, so I never thought about that. I said, no, just chill, just relax. It'll come back up.
I think, to me, Robin, to answer your question in sort of a very politician's way, but get there in the end, is I think, to me, it all starts with about thinking as and when you're going to start needing income to do some sort of cash flow, projecting what income you're going to need over the next, let's say, 30 years, for a sense. As you just know, I've just hit 65. I'm a fantastic age to hit, age 65. So I'm sitting there going, right, so for what do I want over the next 30 years? And literally just before I came online, I saw an article, which I haven't had time to read, so I apologise, about how the fact that people are actually still spending quite a bit of money up until their 80s. But in the UK, we have something called cash flow modelling, where an advisor will sit down with you and go, right, Ian, this is you today. What income do you want? And also build in, for instance, my wife is younger than me, so Nicole's going to retire in 2 or 3 years' time. So you get a picture of your income, and that starts to get you thinking about exactly what you were saying and Bill was saying about when do I need to take income? How do I need to take that income? So at the minute, I don't need to take income out of one of my pension funds because I'm working still, believe it or not. We've talked about that last time, and I've got another pension in payment. So, but having that, I think, a real good cash flow modelling, in fairness, even to me, after 43 years in the industry, it reassured me, because the key thing is, Bill's right, I'm sure he'll come back in. There's 2 things you want to do. One is, I said before, if my financial advisor knew when I was going to die, good God, he could plan brilliantly. He doesn't, so there's some variables. But also, I think Bill's quite right. It's about what do you want to do after you're not here. So are you actually going to leave money to your family or not, to be perfectly blunt? Now, some people go yes, and some people no. So there's some very variables, but some form of cash flow modelling, I think, is so important nowadays.
Yeah, cash flow is king. It's as simple as that. We say it all the time in our, webinars and in-house presentations, etc. Cash flow, is king. And I mean, even you need, you're right, Ian, things like the unexpected fund. From time to time, something will pop up. You maybe need to buy a new car, you maybe need house renovations or repairs or medical issues or whatever it may be. So you should always attempt to at least have an unexpected fund. But the issue with the unexpected fund is that typically, if you don't have an unexpected fund and an unexpected expense does pop up, then where are you going to get that money from? So the chances are you're perhaps not going to be able to take it from your current income, pension income, whatever it may be when you're retired. You maybe have to dip into your capital. You maybe have to dip into the retirement fund. But, in that situation, you can't predict that. But certainly the cash modelling thing is uber important. That is the key. When we do seminars, we do, what is your current budget? Income, expenses. Have a look at that. Do you have a monthly, surplus or shortfall? Okay. Then we say, go out 5 years. You're still going to be working. So we're going to go out 5 years. Same again, income and expenses year by year. Are you projecting any surplus or shortfall in year 3, for example, year 4? And then the third one that we do, it's basically a spreadsheet. The third one is, what is your cash flow is going to be like in the retirement years? And that could be for 10 years or 15 or 20 years. There is a point in time, and I think a lot of people sort of ignore this again, there is a point in time when you can actually reasonably predict your income and your expenses in retirement. Get on and get that done. And that will give you an idea as to whether or not in the retirement years, you're going to have a surplus at the end of each month or each year, and for the next, as I say, 10, 15, 20 years.
I also think one of the things that's happened far more now than ever before is, Bill's absolutely right, cash flow modelling. But we've heard a lot of this talk about intergenerational planning. That's a big in-buzz stuff. What's fascinating is my generation, the baby boomers and Bill's generation, I'm very lucky enough. I've said this before. I've still got three of both my mother-in-law and father-in-law alive, and my mother's still alive. So in fairness, our intergenerational planning, which we think is going down a generation, is also still going up a generation as well. So it's absolute fact. So, and I'm not moaning, and I'm not expecting an inheritance, but I haven't had an inheritance. But if I do get an inheritance, it's a time of my life where actually I don't need an inheritance. It's the most surreal thing going on. So I think it is such a fascinating topic. And I think what we've seen this year is, Bill's quite right. If you're way out of retirement, who cares about the markets? That's very arrogant, but they'll come back. If you're in retirement at the minute and you're taking income out of capital, you are probably more worried about it than ever before, because you can't make it up.
I want to go back to one thing that, Ian, you alluded to earlier. You were talking about the fact that you have multiple pension plans, and this is very common, and particularly for people in my generation. We've had 5 different jobs. We've got pensions in 3 different places. What's your advice here? Should we invest those all with the same investment strategy, the same risk tolerance, or should we say, okay, we'll speculate and take a little bit higher risk with one of these and be more conservative with some of the others?
I think a really good question. I think where my head is and my heart is, everybody is different. I think that's really, really important to understand, Robin. So from thinking about it, everybody has a different attitude to risk. I've met some of the people who've taken the biggest risk in their lives to get to 65. When they get to 65, they go, do you know what? I've taken all my risk getting it. I'm taking no risk with my money going forward. It's almost reverse psychology in a funny sort of way. You also have this great thing, as Bill and I have spoken about, and you have spoken about, you could be looking at 30-year run. So you've got to have a portfolio that's appropriate for how long you expect to live, which is all you can do. And I think people do start to, think about their portfolio, about how much is, let's say, the old traditional equity-based type of assets, and how much you may go fixed interest and gilts, that type of thing. So I think you're absolutely right, but you've got to have this balanced approach, because what you don't want it be, I think, personally speaking, it'd be absolutely ludicrous to have a very, very, very high risk strategy on a pension fund if you're in retirement, if you've got no other assets, just in case the whole lot goes wrong. Because we always talk about what goes right. In the UK, Northern Rock went under and everybody lost their shares. Lehman Brothers went under. So you've got to get it right, Robin. But I think, to me, it's crucial that it's about you, and in my circumstances, Nicole as well. So I think we've got to start doing far more, which I think I don't think we've done enough in the past. It's all about the couples or partners, So Nicole's a school teacher in the UK, so she's got a final salary scheme pension coming into payment. That means there's more guaranteed income coming to us. So if we've got other funds, we could perhaps take a more risk approach, because we've got the guaranteed underlying our investment strategy for our retirement.
Yeah, the risk issue is critical. You're absolutely correct. And, that's a good question, Robin, because, you can't, we say it all the time, you cannot turn the clock back. Now, what I mean by that is that when you're in the working years, and if you made a bad investment or something happened in the working years, you've got the ability to make up. I mean, it might take a few months or years. You can maybe go for promotion, or maybe find another job, maybe get a part-time job, whatever that may be. You've got the ability to do that. When you get into the retirement years and you're a bit older, you may not, have the opportunity to augment the income through, you don't have a regular income. You may not want a part-time job, or you may have one, but it doesn't pay much. So therefore, if you've taken high risk in those years and it goes upside down, so to speak, then you have a serious problem, because not only have you impacted your cash flow, but you've impacted the value of the fund and the income coming out from that, for time to come. And you're right, it could be 20, 30 years. That's a long time. So the risk reward issue becomes very, very critical. I think, Ian, you would probably say that, you know, over the last many years, investment advisors would always tell us that, you know, when you get to like age 65 or you retire, whatever sort of thing, you should basically de-risk your portfolio. I don't think there's anything wrong with that, but I think circumstances and times have changed because you're going to live a long time. I think you can climb up the risk calendar, you know, a wee bit. I don't think you need to go down to 0. I don't think you need to go to 100, you know, %, but you can climb up that risk ladder a wee bit more if it's going to put more value into your retirement fund, and hopefully, as a result of that, get more income coming out of the retirement fund.
Bill, we were just saying, so I hit 65 2 weeks ago. If you go back 30 years in I'm just saying UK, what would happen? Some lovely advisor would come along and said, here's your tax-free cash in, here's your annuity, buy. That's it. That's what happened. The world's changed. You're absolutely right. Having this longer term approach is so vital. In fairness, I try and put things into perspective. It's a bit like your daughter, age 40. She's got 240 wage packets left until she's 60. She might need to fund 360 wage packets. So it's getting that in your head about what you're actually doing. And you're quite right. If you go up the risk ladder, yeah, I think you've still got to have a degree of some sort of asset-based investments. So there's an element of risk. But then again, you know, being perfectly blunt, in the UK at the minute, you know, we've got bank rates at about 1%. We've got inflation at 9%. So leaving your money in the bank, you're losing 8% in real terms. So there's risk in doing nothing, if that makes sense as well, Robin. So it's a complicated area, but it's not. But it goes back to, I go 100% Bill. Start with what you know, right? Get your cash flow sorted out. Then start building the layers of what you do know. So for instance, in my case, my wife's pension and the pension I've got, right, what else do I need? What strategy I need on that money? And if you can, sometimes adapting your income in fluctuating markets is not a bad idea. So if you don't need to take money out, don't take money out. Does that make sense? It really is, you know, suddenly if you think, well, actually at the minute, I don't need to be taking, let's say, $1,000 a month out, don't take $1,000 a month because it could be costing you more because the markets are lower. So thinking about that. Interesting. I mean, we've just been offered. My mum's gone into nursing home. They've just offered us a 2.5% discount if we pay 3 months in advance. My mum being 98, she's not getting 2.5% on the money. So it's more cost effective for us to pay 3 months in advance and save 2.5%. I know that seems but a really sensible thing to do. Now, if I was getting 3% or 4%, that would be a wrong financial decision. Almost getting nothing on that money, we might as well actually take that advantage. So I think it's thinking things like that as well. It's so important to do.
Always fascinating to talk with you two. It gives me so much to think about, and I'm sure our listeners as well. You've been listening to the Ozone Weekly Radio Show, sponsored by the Olderhood Group. If you have comments or questions about the series, you can reach out to us at Bill, that's BILL, @olderhood.com. And we look forward to chatting with you again soon. Take care, everyone.